Uh, let's get started.
Thank you, Cynthia, and good afternoon.
Okay. All right. Hold on just a minute, Troy, and because I do want to thank ProShares for bringing us today's webinar. I want to welcome everyone to today's session, where we'll be discussing thematic investing and how major global changes create investment opportunity. Now, to start with today, I do want to introduce our moderator for today's event, Executive Director of National Accounts, Troy Goldstein. So, Troy, if you would, go ahead and take this away, and I'll actually let me move this over onto your slides so that we can get started. Well, thanks very much for joining us, Troy, and welcome.
Thank you, Cynthia, and thank you everybody for joining us. I want to welcome you to our webcast, How Major Global Changes Create Investment Opportunity. So with that, we're already on this slide. So I'm Troy Goldstein, Executive Director, Head of National Accounts at ProShares, and I am honored to serve as your moderator today. Prior to joining ProShares, I began my career at then Payne Weber, later becoming UBS, and I held multiple key positions and roles across the globe for UBS, first in Weehawken, New Jersey, Zurich, Switzerland, and finally in London. So who's joining me today? Who are our panelists? First, I'm joined with Alex Pileggi, Senior Product Manager for ProShares, where he focuses his efforts on the development and product management of ProShares' innovative ETF solutions. Mr. Pileggi has held multiple key roles in product management and marketing throughout his career, and he actually holds 2 degrees in economics and international relations from Tufts University. In addition, I've got Simeon Hyman with me today. Simeon Hyman is our Global Investment Strategist and Head of Investment Strategy here at ProShares. Prior to joining ProShares, Simeon held multiple top roles at Bloomberg, UBS, as well as being CIO of Lehman Brothers Trust. Here at ProShares, Mr. Hyman leads the ProShares team of investment professionals who are engaged in portfolio analysis, product research and development, education, and the delivery of investment strategies using the company's ETFs. He and his team are also responsible for the development and publication of research, white papers, and other content which hopefully present ProShares as a leader in the ETF industry. Mr. Hyman earned his bachelor's and master's degree in economics from UConn and his MBA from Columbia Business School. In addition, he also holds the CFA designation, and you may recognize him from being on TV quite regularly. Okay, so before we kick off, let me try and set the stage a bit. Today's markets are among the most complex in recent history, and while the government stimulus may have helped, the markets are still far from stable. We've seen the markets drop dramatically and then rebound quite incredibly as well. It means you must look beyond the broad market for trends, themes, and opportunities to take advantage of, both short-term, but also as long-term trends, due to the life-changing environment we now appear to be living in. With the market shifting and the volatility that we're experiencing, it is often discussed that now more than ever, certain themes will be accelerated to the forefront of our daily lives, and thus bring with them some investable opportunities that we can all take advantage of. With that, I want to take a look at the agenda, which is already up for today's call. And if we look at the agenda, I want to start with how ETFs in general have evolved over time from providing very basic exposure to the markets and where we are today. And then I want to shift to the topic of the day, thematic investing, and the framework around that topic. From there, we're going to jump over to we'll focus on how to capture investable opportunities within thematic trends and how ETFs could play a big part of that. And then finally, look at the actual thematic investments and using them within your portfolio construction and management. So let's go ahead and kick off. I wanted to quickly touch on how the world of thematic ETFs came to be. And let's back up a second and look at the evolution of ETFs over time. So, that look back begins with what we would consider ETF 1.0. And if you look at ETF 1.0, what you basically see is your basic broad market exposure. And that was the origination of how ETFs came to be. As we look and move to ETF 2.0, we can see that ETFs were beginning to be utilized not just for broad market exposure, but also investors were starting to turn to them as vehicles to zero in on sectors, certain countries, breaking down markets into narrow market beta. And as the world of ETFs continued to gain strength, we saw certain rules-based strategies begin to pop up, which in today's day and age, we often refer to as smart beta strategies. However, in a market such as we are, and we're living it in today's market, it has become so important to be able to focus in on the investment in the investability of themes, trends, life changes, which are more and more being captured in thematic ETFs. As we move through today's presentation, I want to note that thematic investing can help target changes that are felt across global geographies, sectors, industries, and Morningstar style boxes. And by nature, conventional stock market classification systems are backward looking. As a result, traditional indexes may fail to account for rapid changes or emerging opportunities like we're seeing. And with that, I want to bring in our first panelist, Alex Pileggi, to kind of discuss the transformational changes that are impacting the world today. Alex?
Thanks, Troy. So as Troy mentioned, we're going to discuss how thematic ETFs transcend and even transect sectors, industries, and the equity style box altogether. And they can help investors target opportunities impacting companies all over the world. So what are some of the characteristics of transformative changes as we see them? Well, these are broad structural shifts, not passing fads, and they have enduring consequences for businesses and society at large. The disruption that they'll bring, they'll create winners and losers across the investment landscape, and the impacts won't just be measured over the next fiscal quarter, but over the next quarter century. So at ProShares, we're focused on three powerful changes. The first of these is urbanization. As people in both the developed and developing world move into cities, massive investments will be required to accommodate that phenomenon. The second change is in demographics, specifically people who are living longer. Millennials have become the largest generation on earth, and many of those younger people are delaying having children or forming households altogether. For anyone familiar with ProShares, as you may have guessed, those millennials, they have pets instead. So the third one is consumer transformation. People are increasingly informed about the products they buy, and they can use digital platforms to secure the highest quality goods and at the best prices. Buyers have never before been more discerning or had more information at their fingertips than they do today. So the next slide, we'll talk a little bit about how transformative changes become investment opportunities and how we identify those. So while the changes might be embodied in things we experience every day, like when we ask Siri a question or check out movie recommendations from Netflix, identifying the actual investment opportunities these transformations create can be difficult. And the impacts of the changes are felt across geography, sectors, industries, and the vaunted Morningstar style box. As Troy mentioned, there's a problem. Conventional stock market classification systems are backward looking, and traditional indexes may fail to account for rapid changes or emerging opportunities, particularly that are growing. So why is that important? What do we mean by that? Well, Tesla still is a member of the S&P 500, and it wasn't long ago that very few indexes or US-based ETFs owned Alibaba. Those are two companies synonymous with growing, potentially disruptive business models. As a result, we need a different perspective. Shaping portfolios around long-term transformative changes requires a research-oriented approach and a sophisticated toolkit. So ProShares takes a forward-looking approach in analyzing the economic impacts created by converging transformative changes. And we ask the big questions. Will the transformation create new industries or businesses or threaten old ones? Are these new businesses or new business models altogether? What are the drivers of earnings and future profitability? These are critical questions to dimensioning the potential investment opportunity. Once an investable theme comes into focus, the next step is to isolate companies that stand to benefit. They may include newer businesses that are dedicated to a specific theme or established firms positioned to exploit the industry dynamics. Understanding whether companies in the value chain are public or private, whether or not they have economies of scale or barriers to entry, is crucial to pinpointing those poised for potential future growth.
Alex, that's really good information and kind of, brings us to the big question, which is, okay, I've identified a theme. How would that look and how would I incorporate that into my business, into my portfolio? So could you maybe talk a little bit about that as well as you move forward?
Sure, Troy, I appreciate that. Go figure. We might even have a slide that speaks to it. In fact, it might be the next one. So before we discuss the specific investment opportunities we focused on, as Troy mentioned, let's take a moment to think about where thematic ETFs may fit in a portfolio. So these focus on relatable trends we experience in our everyday lives, and introducing them into a diversified portfolio may help investors stay invested and, importantly, focus on long-term growth. We know that picking single stocks is difficult and it can increase risk. You know, the Peter Lynch's, John Neff's, the Warren Buffett's of the world, they're rare birds these days. But traditional index ETFs may be too broad to capture a targeted or high conviction opportunity. ProShares thematic ETFs rely on a transparent, rules-based index with precise approaches customized to capture a range of companies that may stand to benefit from changes. So how might they be used in a portfolio exactly? Well, a few different ways. Some things come to mind. To differentiate portfolios and engage themes that resonate with you is a good reason. As a satellite, traditional core equity and fixed income portfolio is another use case. Or, in industry parlance, to add alpha to potential existing allocations. A few ways that thematic ETFs might be used. On the next slide, we'll talk a little bit about the investment opportunities that we've identified. So just a few notes before we give way to Simeon. That online retailers have made headway at the expense of bricks and mortar stores is no secret to most investors, and Simeon will explain how that trend is still in the early innings and may even have been accelerated by recent events like COVID. The importance of critical infrastructure projects and the unique economic characteristics of those toll collectors is another potentially compelling investment opportunity, and it's particularly attractive when yield may be tough to come by. And finally, the humanization of pets continues the world over. In the U.S., the growth has been driven by the two largest generations, specifically millennials and boomers, and many companion animals are now at-home coworkers these days, so it should come as a little surprise that this opportunity is front and center to many investors. So without further ado, we'll give way to Simeon
Alex,
to start with.
That makes a lot of sense, and thank you. And you make it seem so clear and so easy. So, I want to jump now to kind of an in-depth look at each of those actual identifiable thematic opportunities in a deeper dive for our audience. So at this point, I would like to bring in Simeon, and thank you, Alex, for almost doing that a little too early, but Simeon, I'd like to bring you in as our global investment strategist, and I'd like you to start with let's start with retail disruption story that Alex talked about, as it really seems to have hit home. It's really accelerated in our current, state of kind of what I call work from home, stay at home lifestyle. So, Simeon? Simeon, are you out there?
It would be helpful if I took the mute off my phone. I was trying to be so considerate of the first presenters.
Thank you so much. And Simeon, we appreciate it. So why don't you take it away, retail disruption.
Thank you so much. So a couple of things to note. First, so the slides scrolling all over the screen. They keep moving. So a couple of markers that are important here. If you go to the e-commerce report that comes out of the U.S. Census Bureau that came out at the end of 2019, you'll note about 11% penetration of online retail e-commerce in the total retail pie. And this, Alex had already pointed out, it's a couple points higher globally maybe, but somewhere in the mid-teens no matter how you slice it. But the other takeaway that's really important is that online retail has been growing at 4 to 6 times the rate of brick and mortar. So you've got a recipe for an insistent and compelling trend that has a long way to go. And habits are changing. I'm just going to highlight one that I think is really important. As an example, take a look at grocery. Grocery is the most penetrated category of online, at least it was. As of the end of the year, only about 3% of grocery sales were online. Who knows exactly why this is, but one might imagine people like to, touch and feel their vegetables, or they just like to browse and see what's interesting. A million reasons you could think of. I would venture to say that nearly everybody's getting groceries delivered in this pandemic, and so even the least penetrated category may have some persistent changes in habits that will be hard to break coming out of the pandemic, yet still coming from that low penetration, which means there's a way to go. The other thing we notice is that not all online retailers are created equally. Scale is so important that, of course, Amazon and Alibaba, when you look at the two key global players, are critically important to the penetration, but also, success begets success. It doesn't mean it's all about Amazon. Niche players like Chewy have made inroads as well, but it means that big is important. It's not always important in certain industries, but it's certainly big in online retail. So if we flip to the next slide, again, this is a forecast, and this is what we think might be a little bit accelerated. This is where, eMarketer gave us this number at the end of 2019, and you could have picked another half dozen vendors thinking about this. And they all got to somewhere around 20-25% in 5 years. So again, let us just assume that this goes a little bit faster. Maybe we get to 30-35% in 2023, just more information of how much room there is to go. And one more piece of the puzzle here. In fact, to give you a sense of how quickly things are moving, and again, yet how far there is to go, we used to do this slide just about 18 months ago and say that Amazon was 1/3 the size of Walmart. It's now half the size of Walmart. So it's moving quickly, but just think about that distinction. Walmart put out of business Main Street, for those of us who were around about 30 or 40 years ago, and Amazon has the opportunity to do the same in e-commerce, but still only half the size of Walmart today. So more indicia of the speed of change, but also where we are in the process. Flipping to the next slide. This is the other side of the coin, the brick and mortar side. And we know that, if anything, bankruptcies are going to accelerate and closings are going to accelerate from the pandemic. You cannot turn on business TV without hearing of workouts, whether they be Nordstrom's or Chico's, or even Dick's is having financial challenges. So everybody's having financial challenges, and closing stores and bankruptcies are abounding. So that's the flip side of this, to the benefit of the online retailers, but to the detriment of the legacy players. And I might add, just as we look at this slide, just one more note. We know that there are going to be a few of the legacy players that just might come out of this okay, but we'll talk a little bit later about how that impacts our design of an investment opportunity. But don't take this to say that there is no life left in brick and mortar, but it is a very challenging road to hoe for lots of players.
Thanks, Simeon. And wow, that's a lot of information, and it really hits home in today's environment and what we're living with. So I know that it's a story that's gotten a lot of play, and I know that personally, I've never gotten so many boxes delivered on a daily basis, and yet haven't been to a store in weeks now, actually months now. But, as you mentioned, this is a longer term cultural change, and one that has been brewing for a period of time. And as you just pointed out, is still in the early innings. So thank you. Okay, I want to change gears a bit now and focus on the second identifiable theme that Mr. Pileggi threw out there, and that is infrastructure. So, Simeon, could you kind of dive into infrastructure a bit and how we view infrastructure and kind of infrastructure as a kind of never-ending need?
Sure. Look, I mean, this is also a newsworthy item that everybody is seeing, and frankly, we all would love to see some of this get done when we're not using it as much. So there's lots of hope for governments around the world to repair and build out infrastructure for the 21st century. It's an asset class that has very unique characteristics, and we'll talk about how we define this even more specifically as we talk about the investment opportunity. But when you think about things like communication, transportation, energy, and we'll talk about what kind of energy we mean here, but you can see it looks like the way energy is transported, not necessarily drilling it out of the ground, and even things like water. These are consistent demand, stable cash flows, and high barriers to entry. Whether it be rights to train tracks, whether it be cell phone towers, which you can't keep building them without getting permits from all the municipalities and other elements of scale and regulatory constraints. And if you flip the slide over, you'll see, again, what we all know, that a ton of money needs to be spent here, whether it's on aviation, energy, ports, roads. Again, we would love for some of this to get started. I see these memes on Facebook all the time of can you just fix this highway now while we can't go to work for a few weeks or a couple of months? So the need for that investment globally and the shortfall from where we are today offers a big opportunity, and it's an opportunity that, as we will specify, we do think is an investable opportunity. But you have to think this one through and think about how you want to access it. And to give you a little foreshadowing, which we'll talk about in a couple of minutes, there are those that own the assets, and then there are those that build the assets. And I'll leave you in suspense in that for a couple of minutes as we move to one more theme.
Thanks, Simeon, and some great points there. So, we often hear the need for infrastructure, both here in the U.S. and abroad, is ever growing, and the opportunity to capture the investment is a pure play methodology, and seems like a significant long-term opportunity and not something that's going to be solved tomorrow. So thank you. As we hit on retail disruption and the shift to online, and now we discuss the growing need for infrastructure, I want to ask you something, to touch on something a bit more fun. It's something appears, by the numbers I've seen out there, is such a growing industry and one that's moving forward each and every day. And I'm going to steal something that Alex talked about early on. I loved his line of our coworkers of today, and that is the pet industry. So, Simeon, could you kind of take us through with the opportunity and what's driving the pet industry?
Sure. Yeah, I think for a lot of people right now, their pet is their only friend, perhaps not even their best friend, because we can't go anywhere. So there obviously is a much like the other things we were discussing, there is sort of the quarantine and pandemic highlight, but this is a really long-term trend that's been going on. 7 out of 10 households have pets. More pets. There are more households with pets than children, and that surprised me in and of itself. But also, just the stability of this business. If you look at the pet care industry, it actually grew in the Great Recession, which is some of the stability that we're looking for in this current environment, because people will take care of their pets no matter what. And if you flip to the next slide, you'll see just some of those numbers and some of the trends that are making the industry grow even faster than, sort of the head count, if you will. People are treating their pets like people, and premiumization. You see all the people cutting up steaks for their pets. So premiumization and humanization across the board. And then, of course, state-of-the-art healthcare. $15,000 for a new hip for your dog. Who would have ever thought of that years and years and years ago? And as we'll talk about the investment opportunity, we think each of these elements contributes to a very unique investable aspect if you construct it right with regards to the industry. And you've got some markers here of an industry that will roughly double between 2016 and somewhere over the next 5 years. Grew, as I mentioned, in the Great Recession. And it's nice to see the smart money going on here, too. You see a lot of corporate activity, M&A activity, whether it is the combination of healthcare players or the acquisition by consumer staples companies of pet food businesses. All of that is just indicia of the health of the sector. And again, if you do it right, we think there is opportunity for the individual investor, too.
Thanks, Simeon. And you've definitely made the case for these three identifiable targets. So now I'd like to look, at how we move from an identifiable theme to the actual offering. So, if you could give our audience kind of a little insight into the product characteristics, key information, things like that, and how we capture an investment opportunity. So, if you could take us through kind of that movement from trend to theme to investment.
Sure, Troy. I'll start. Sometimes it's useful to think of what hasn't worked and then go from there to a framework that we think can work. So let me give you 2 examples of themes that haven't worked as an investment opportunity. One was solar. Remember, everybody was trying to invest in solar several years ago? All the solar companies went bankrupt. So first, there may be a theme that's really important. The growing market share of renewable energies is a really important theme. But wave one of those companies as independent entities just didn't work. So you kind of got to see what the business model is and whether that's profitable. Then number two, you got to see if there's actually companies that isolate the themes. And so I'll go to number two that didn't work. Blockchain. Blockchain didn't work because it's not important. It didn't work as a theme because all the investment vehicles, whether mutual funds or ETFs that were focused on blockchain, ended up being a portfolio of global financial institutions for which 1/10 of 1/100th of a percent of their business was profitability of blockchain. Didn't mean they weren't using it like crazy, but just way too diversified to be capturing the theme. So you got to see that the industry has profitability. You have to find companies that are able to isolate it, see if they're going to have some barriers to entry, even if they're companies that are currently profitable, if they're just going to disappear in a year or two and merge away into conglomerates. And then finally, are there economies of scale? So these are all the elements of going from a trend to a theme. We took you through the three themes, but now we want to talk about how you make those investable. And each of these will show you how we thought through those key elements of the tale to put through well-thought portfolios that we really do think make for investment opportunities. We can flip to the next slide. Oh, I'm sorry. Go back one. Go back one more. Now go down. I was looking at my second screen and confused myself. Aha, okay. So retail disruption. We put together two important vehicles. As I mentioned, there were two aspects of retail disruption that were important and capturable. One is simply the growth of online retail, for which we put together our ETF ticker ONLN. And then to take advantage of not just the growth of online, but also the devastation across brick and mortar, we also put together a long-short ETF, CLIX, which tracks which actually takes a 100% long position in online retail and 50% short, so it's 50% exposed, of the Solactive-ProShares brick and mortar retail store index, so that you have the opportunity to just be long and then long short. And if we go to the next slide, just some details here. Now, here's where we got into the construction that was important. As I mentioned, economies of scale are very important in online retail. So the two things we did here is, number one, we market cap weighted the online retail index. Now it's capped, so Amazon is 24%, Alibaba is somewhere around 12 or 15 these days. So there's opportunities there for other folks to contribute. Chewy today is 5 or 6%. Wayfair's in there again. So there are other key contributors, but it does indeed recognize that economies of scale are important. And of course, online retail is to some extent borderless, so you really need a global portfolio. So market cap weighted and global are the key distinctions of the online side. But if we go to the next slide, this is just by weight. So this is before rebalance. So you can see Amazon was doing quite well in that quarter. So actually intermonth got a little bit above the 25%. You'll see the other key players. You'll see Chewy, Stamps.com, eBay, etc. And you'll see the global nature of the portfolio, about 3/4 US and the rest ex-US. So a very good representation of the universe. Now, the brick and mortar index is equally weighted. Why is the brick and mortar index equally weighted? Because of the basket of companies that are in that index, the way we perceived it as an initial portfolio construction challenge was, hey, a couple of these companies just might get, I don't want to say lucky, but they just might get that omni-channel thing right and succeed. But the vast majority won't. And if the chances of that success are sort of equally represented across this short portfolio, then one would equally weight it. Just so happened to have come in incredibly handy in the quarantine period. Why? Because Kroger and Walmart did well. So what? The index is down 22%, contributing to CLIX being up 17% in the pandemic. So equally weighting is important. So that was the construction key here, was to market cap weight the online side and equally weight the brick and mortar side. And again, this is the current rule is 75% of retail revenues from in-store sales. I'll give you just one more thing that's important to note here. as some of these companies do increase their online presence from, say, 5 or 10 to 15 to 20% of their business, for many of them, that means even worse margins and worse performance. So even modest success in not going out of business doesn't mean the stock prices are doing well on the short side of this one. So that's how we put together the retail disruption suite. You can see on the brick and mortar side how that equally weighting plays out. Again, that's equally weighted at every rebalance. And you can see if you look at the segments, just about all of them, almost all of them are disasters in the making, with the exception of maybe food retail, which of course is having a little bit of a hiatus from its devastation. But again, even food retail, as we see the incursion of the greater incursion of e-commerce from low penetration, is still at risk. So let's keep looking at our thing. Oh, and this is performance, I should say. This has not been just a pandemic period outperformance of online versus brick and mortar. You can see that since the inception, and we had incepted this ETF almost the two indices, and CLIX is an ETF, and then subsequently ONLN long before the pandemic. So we're glad that it's been highlighted, but this is not one of those little gimmicky pandemic trades. This guy is a long time coming and a long way to go. And you can see standardized performance. How did we put together the infrastructure? Oh, go ahead, Troy.
I was just going to say, Simeon, I think that is a great story and a great point that you just made. It is a longer-term trade and something that we saw the trend moving in that direction long before the pandemic. Of course, the pandemic has put it in front of investors and minds and something that we're living day in, day out. So I think that is a good point that, one, we're in the early stages. Two, it is something that we saw as a global trend kind of moving in that direction long before the pandemic. But the pandemic has really accelerated the trade and kind of made it something that we're all feeling day in, day out. So if you could move onto infrastructure, and then we'll hit pause as well.
Sure.
And I appreciate that, Simeon. Thanks.
No, I got to tell you, the retail disruption suite, as much as anything, has forced me to very quickly put on a shirt, tie, and a jacket on top of my whatever leisure wear I have on the bottom, because I keep getting calls from the media to talk about it because it's at the top of all the performance lists. But the long-term trend is critical. On the infrastructure side, this is the key. The key here is that the portfolio is composed of companies that own the infrastructure assets, as opposed to the companies that build the infrastructure, like a construction company or an oil driller. And we think that's really important, because owning the asset is what gives you the stability of the cash flows. It doesn't mean yet you don't participate if the bill comes through. It just means that's not your only ticket. So sometimes I've given the example of an airport with 3 runways and they're at capacity. They're not at capacity right now, but they will be again one day. But imagine that's the case. Or let's take cell phones, even better, because we were just noticing a couple of hiccups in cell coverage this morning. So imagine, your cell phone network is at capacity, you're making lots of money, and you need to add 20% capacity. The company that builds some more cell towers makes money once, but your revenue goes up 20% ad infinitum, and you already had stable cash flows to begin with. So this gives you that stability, but also the ticket if and when there is expansion and investment in further infrastructure. You don't just have to bet the entire thing on gridlock being avoided in Washington. Next slide. And here's where we just sort of give you the schematic of these being the pure play companies that own and operate the assets, where you have other strategies that will focus on the folks that are building the infrastructure piece of the puzzle, which is a little bit more of a cyclical bet. Next slide. And here's one of the key distinctions. We didn't talk about this so much, but we want to emphasize it here because it's useful to think about. Diversification still matters, and the TOLZ and its index are very useful diversifiers. Having a 10-year beta of 0.75 to the equity market That's about as diversifying as long-only equity gets. You really, beyond that, then you're talking about really pure alternative strategies. So this is a very diversifying slice of the equity markets, which makes it a very nice, behaving satellite to add not just performance, but also a risk-adjusted performance to portfolios. And there's your standardized performance. And here you can see the outperformance. So you can see the outperformance of the pure play approach that we're advocating versus S&P's infrastructure index, which sort of has everything. It has some owners, it has some builders and things. And this is a global portfolio. It's about 50% US, 50% ex-US. So we compared it to the MSCI World Index. This is the last one. You know, we don't always like to lead with this, but it's because I think that it's always risky to stretch and seek high yield. That can be a risky investment strategy, but the stability of the cash flows in the infrastructure strategy allows one to have stable yields, but also, frankly, juicy yields. And here you can see that you're getting anywhere from, over the course of the life, anywhere from 3 to 5% yields, which can be nice in a portfolio, particularly in a world where the 10-year bond is somewhere around 50 basis points. To have some yield in the portfolio, but to have it in a stable source of yield is very important. So that's a real extra little bit of icing on the cake with regards to the infrastructure opportunity. Here you can see 50% US, 50% ex-US. You can see the lineup by sector, and of course we should be clear. We got energy in this guy, but remember, this is not drilling. This is the transport and distribution. Doesn't mean it doesn't, get a little whiff of a cold when really bad things happen. But, as an example right now, with all the turmoil in the energy sector, TOLZ is just a hair behind the S&P, and we think that's a testament to the stability of the midstream aspects of the energy that's part of the infrastructure story. And our last theme, lots of fun, PAWZ. So this is the one where you got to figure out if they're pure plays, because the pet care industry is composed of some companies that are dedicated to the pet care business and some that are conglomerates. And this is where we took a lot of time to make sure we didn't create the blockchain ETF that looked like a bunch of financial services companies. And in fact, we did identify that there were enough pure plays to really make a good ETF, a good portfolio, and a good index. But we didn't want to ignore the fact that there are some conglomerates, particularly in the food space, that have big pet care businesses. So we allowed that to be a minority piece. And I always ask Alex, why is it 82.5 and 17.5 and not 80-20? You should send that in on your Q&A to make so that you force them to call you personally. So that would be fun. But we made sure that there was a little bit of representation, but the vast majority of the portfolio is in. He's chuckling there. Put yourself on mute if you're going to laugh. And the other thing I was just going to note, go back to that slide one more time, because I want to just note, we list these 8 buckets. I almost think of them as 3. It's making stuff, it's selling stuff, and then it's all the healthcare. And the healthcare is about half. And now you can go to the next slide. This is also a global portfolio. It's about 2/3 US. So you've got some key players out there, like Zooplus is a very prominent online retailer of pet supplies in Europe. You can see Freshpet is food, and you see lots of healthcare pieces, Decra, IDEX. And you also see a modest representation of like a Nestle. Nestle and Smuckers are a couple of the companies that have big pet food businesses within their large conglomerate, so they get a minority piece. And standardized performance.
Thanks, Simeon. And yeah, I mean, Alex, you want to jump back in here and as senior product manager, you want to take us through the tickers? Because I know that's something that we want to get out there. Alex?
Sure, absolutely. So thanks, Troy. All of our ETFs listed here rely on rules-based transparent indexes. We'll start with the Retail Disruption Suite. So that's ONLN, ProShares Online Retail ETF, which tracks our online retail index. CLIX, CLIX, the long online short stores ETF, which tracks our long online short stores index, and then TOLZ, ProShares, Dow Jones Brookfield Global Infrastructure ETF, which tracks, as the name implies, the Dow Jones Brookfield Global Infrastructure Composite Index, and then finally PAWZ, our pet care ETF, which tracks an index from our partners at FactSet, the FactSet Pet Care Index. And that's the lineup. Thanks, Troy.
Thanks, Alex. And you know, before I let you guys go, we have a couple questions that I wanted to throw out to the two of you and maybe have you address. So I'm going to try and vary them a little bit. So we may get one of one product, one of another, but not sure who wants to take these. So I'll just throw them out. So the first one comes and it says, you know, what makes you so confident that it's not too late to invest in e-commerce opportunity?
Yeah, I'll take a swing of that. And sometimes it feels like a broken record, but it's just so easy to look out the window. And now it's not just that the boxes are in our garages, because I don't know about you, but all my garages are on my front stoop, because you take the food one thing at a time or whatever came, and then you wipe it off and you leave the box on your front stoop. But it's just there is such a long way to go, and there are a lot more companies that are going to go through workouts and bankruptcies on the brick and mortar side. As I said, even to get to 1/3 penetration would make the online world double the size, more than almost triple the size that it is today, and particularly with the underrepresented segments of the retail space, like grocery, that have been getting traction in the pandemic. Habits are hard to break. It's going to go a little faster, but still lots and lots of long ways to go. So don't think that just because the stores have been closed and almost everything is online for a couple of months that there isn't long legs to this theme.
Okay, I think that one was too easy, and I think I could have answered that one. After listening to your presentation. I'm going to jump to another one here. What have you seen in the quarantine period in the pet care industry? Is it staying stable? Is it the same across the board?
This one's a little more intriguing because you have different pieces of the pet care business. So the answer is, what we've seen is that anything you can do in your house has been it has been a real boon. So in other words, as you might expect, and overlapping with our online retail discussion, everything that can be delivered to your house, whether it's food or supplies, is doing incredibly, incredibly well. And the only thing and by the way, and I say not as well, meaning not going through the roof, but still better than the broad market, there is some pent-up demand for veterinary services, because it's not quite as easy to get to the vet. Even that segment, even the healthcare segment, is now performing the S&P 500, but not to the extent of the things that can be delivered to your house. So we think that's another leg for catalyst as we hit the other side of this pent-up demand for pet healthcare. And I'll close with my favorite line. There will likely be a enhanced push for more government involvement in human healthcare, but that is highly likely to not extend to animals, because there ain't no Medicare for dogs. And that's a real opportunity. That's a long-term trend, but also a little bit of pent-up demand from the pandemic.
Interesting, and that was a little tougher one. I'm going to throw one out here on the infrastructure side. So there's one here that says, what are the prospects for TOLZ in the event that there isn't a big infrastructure spend by the government? And I'm going to add to that the question, you talked about toll keepers, because there's another one here close about toll keepers, and do you see a rise with people returning to work of the toll keeper world, or do you see that staying stable or going down? So what are your thoughts?
Well, I should say that we meant toll keepers as an analogy. So there is a theory that more people will be driving to work because they won't want to go on public transportation, and that may be a leg for a little bit of resurgence in energy. But we'll park that to the side. I think the key here is focusing, and this one we already talked about a little bit, but I'll just try to reinforce it, that even if there isn't an infrastructure bill, the fact that the portfolio is comprised of the companies that own the assets and they already have that stable base of cash flows is really important to the design of the portfolio as a stable place. It will benefit. These companies will benefit if there is spending, but it's not a disaster if there isn't. And particularly in some pent-up demand for things that are not just explicit toll takers, but implicit toll takers across the various pieces of infrastructure.
Interesting, and thank you. I think we're going to close there, and as we close, what would a presentation be without a risk statement and a couple slides on disclosures? So as we go through the next couple slides, please remember that if you'd like a ProShares prospectus, you can request one by calling our Financial Professional Service Center at 866-776-5125 or downloading it from ProShares.com. Of course, please don't hesitate to call us if you have any questions that haven't been answered today. And as always, as they're on the screen, ProShares is there to help our investors with any questions or support. So if you happen to think of a question later, please feel free to call that number on the slide, 866-PRO-5125. One of our ProShares service representatives will be happy to help you with any questions or concerns. And now I want to thank you all for attending and thank our speakers today, Simeon, Hyman, and Alex Pileggi. I think they were great panelists, and I appreciate all their insight and information. So with that, on behalf of ProShares, we thank you for joining us.
Well, I would like to extend a great deal of thanks to ProShares for today's presentation. Special thanks to Alex, Simeon, and Troy for a great job here this afternoon. Now, I do want to mention we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review the concepts that we've gone through here today, simply watch your inbox later on for a direct link to today's recording and also to the same slides that are used during the webinar. By the way, if you'd like an advanced copy of the slides, notice in the control panel on the right-hand side of your screen, there's a handouts title bar that does have a PDF copy available for you. So you can download that directly from here. But that is going to conclude our session here this afternoon. Thanks to ProShares for a terrific presentation. And I also want to thank each of the participants for the time that you spent with us this afternoon. Have a great rest of your day, everyone. Thank you so much. You can exit using the X in the upper right-hand corner of the screen. Have a great rest of your day, everybody.